I'm Vanessa Konecki, and this is Research Administration in a Nutshell, a series where I make short videos about different activities that we engage in as research administrators and what it's like to be an RA. Drop a like on the video or subscribe to the channel on YouTube for more research administration stuff. And now, let's get going. We've gotten the NOAA, the award letter. Congratulations, you're getting money. Now, maybe the agreement has already been fully executed, the contract's been signed, whatever the mechanism, you now know that money is coming in somehow from somewhere. Depending on where it's coming from and how the agreement terms are written, there are a variety of different ways in which we actually get the money into the organization. Now, this is something when I first started out in my research administration career, I didn't actually know. So I had a lot of grant accounts that basically said, this is an NIH grant, this is a clinical trial, this is discretionary, this is cash, whatever, right? And it's telling me that, okay, these are accounts that this investigator can spend from, and each one's set up a little differently and they have a different purpose. And my job was to manage the expenses that posted to the account, make sure that they were allowable, allocable, reasonable, the whole nine, that they were in accordance with what we had said, so on and so forth. Now, initially, that's what I spent my time on. But as I grew in my career, I realized that depending on the type of these accounts, the money arrived in the account in very different ways. And what I saw on my general ledger could mean a variety of different things depending on how the project was set up. I could go down a rabbit hole with each of these types that we're going to talk about today, and the complexity of your financial and grant systems will determine a lot about what you see and what you don't see. On top of that, your role in the organization will also dictate what you are and aren't responsible for. So for the purposes of this video, we're going to really focus on an overview that gives you a basic understanding of what we're talking about and give you enough to run with so that you can take questions to your manager or carry on the search for information in your own organization or using Google. Also, this list isn't meant to be exhaustive as much as it's meant to be a way to get going. So if you have something that I missed, please add it to the comments below. And also, while you're doing that, don't forget to like and subscribe and share the video. So let's talk about it. How we receive the money can determine whether we're spending actual cash. Okay, so like I have $5 and I'm paying the cash, or if we're retroactively getting reimbursed for expenses that we have already incurred as an organization. Okay, so if we're getting a lump sum of cash in the beginning, then we're spending against cash that we already have. And that means that there's risk. There is no risk. There's really no risk. Right? You've got the cash, you're spending the cash, there's no risk there. We have the money. But what if somebody, an organization or a company says they're going to give us some money, and the basis on which we get the money is that every time you complete a certain activity, reach a certain milestone, we invoice them and then they pay us. Okay. In this case, the cash money isn't going to come until after certain obligations are met. For example, once you enroll 30 patients, we will then pay you $1,000 per patient. Or once you finish milestone 1, you will get $10,000. In these cases, we aren't paid until those obligations are met. Now imagine if the PI is unable to meet the obligations, or if let's say the organization that we have a contract with goes out of business before they're able to pay us. Now the PI's organization is going to have to figure out how to pay for those expenses from its reserve because there's no cash coming in to pay for that work that's already been done and charged to the account. Because remember, the work is already done to get going. Who pays for that, right? Typically, it's going to be the PI's discretionary or sundry funds. The department might need to get involved. Organizational reserves might need to get involved, something like that. But that cost has to get paid for by somebody. And that is the risk inherent in payments that come after the fact. Now, if you recall, so when I first started back in the day, I was only looking at expenses and grants and just sort of doing my due diligence as a research administrator, but it was at a fairly basic level, right? But now, as we're talking about it one step further, I'm looking at those expenses in the context of the account that they are on and the nature of the flow of finances to and from that account, okay? The flow of money to and from that account. Our responsibilities at that point in terms of what action to take on this information really depends on your organizational structure. So you'll want to find out how deeply you need to get involved in this. But regardless of your involvement in the day-to-day management of this level of the finances, it's really helpful to be aware of how this works on the back end, especially when closeout time comes, because that's when questions begin to get asked and these ideas matter more. Let's start with drawdown. So let's talk about how grants awarded by many federal agencies and a lot of foundations and plenty of other organizations operate related to the money that we get, okay? These agencies typically operate on a promise to pay for expenses that are already incurred. In the way our practice typically works, you'll get a NOGA, okay, and the NOGA will say, you've been awarded $1 million, congratulations. That letter, that NOA, is a commitment to pay you those funds. It is not a notice that you're about to get $1 million in cash, okay? In larger organizations, once this announcement is received to say, yes, you've been awarded, the budget for the current period, the budget period that you've just received, is going to be posted in your general ledger, right? So now when you look at your finances, you will see the budget posted, even though there's actually no cash in that account, okay? Now, the PI and the staff spend on that project, as do others in your organization for other accounts. All these things are getting spent on. And everyone who is spending spends away, and we're spending in arrears, okay? Because remember, at this point, we have still received no money from any agency, and we're spending, and the organization is floating the cash. At the end of the month, your financial office runs a report on all of the accounts and all of the expenses and everything that they need to get reimbursed for. And then they will log into the ancient and antiquated system that was probably invented at the same time as GeoCities, called the Payment Management System, uniquely named PMS, and upload an expense report of all grants for that budget period. Every grant that got anything spent on gets uploaded, and it's all coded to say, okay, well, this project spent this money, this project spent this money, and so on, okay? Typically for a bigger organization, it'll be like a spreadsheet that gets uploaded, but then smaller organizations may do it like literally punching in the numbers because they don't really need a spreadsheet for that. Now, at that point, once that's punched in, the organization draws down the funds to reimburse the organization for the expenses for the prior budget period, and then the process begins again. For an organization that is large, that can often afford to carry that much debt in a short period of time, this is not that big of a deal. But I work with smaller clients that sometimes need to receive funds in some cases prior to expensing for like big purchases. So for example, if you're a biopharma or a small company that is operating entirely off of a grant, which is not super unusual these days, or if you have you're a smaller academic organization that has fewer projects, right? You may need to have the money in advance from the drawdown, like in advance from like expensing it to be able to pay your payroll, right? Because those are, or you may have a large expense like equipment or something that you need the funds for to be able to do the thing. Now, in those cases, the Fed does allow a pre-drawdown for up to 3 days before the expense is actually incurred. But this is a really delicate and specific procedure, and it has some very specific stipulations. So if you are a smaller organization doing this or trying this out, please be sure to read up on it thoroughly before advancing your drawdown. There is a link in the show notes for you to click on, and it'll take you to the section in the NIH policy about it. But you'll definitely want to do some research related to your specific funding agency in terms of what they allow, because not all funding agencies will allow that. Now, these types of grants, the ones from federal agencies with a NOA of some kind, are typically, or a contract of some kind, but they're federal agencies, are typically very low risk, and so you'll monitor those in accordance with budget and expenses and so on. There is typically not a whole lot of additional work that research administrators need to do on, like, in terms of managing that, other than making sure that the expenses in the post are allowable, allocable, and reasonable, with, of course, the understanding that more complicated grants take more complicated management. But in terms of receiving the money, right, typically there's a finance office that will work with you that will help you, close out the project, ensure funds were spent appropriately, and so on. So it's a lesser, like, we don't get really, it's a very standard way of operating. Now let's say someone says, I'm going to give you X amount of money. They're going to give you cash, one-time payments, gifts, donations, big things. So that's another way that we get money. So I'm Vanessa Konecki, I'm a billionaire, and I want to give you Dr. So-and-so a couple $100,000, or maybe I want to give you $10. Like maybe I'm a grateful patient giving $10. Regardless of the size of the gift, in that case, you will more likely get the funds in the form of a check, a wire, some sort of thing that is like a cash situation, and you deposit it, it posts, and that cash is now in that account. Okay. For example, I can pledge to say I'll give you $300,000, and it'll be done in 6 payments of $50K each. And then every time you get $50K, it goes into that account, and you'll just spend on that $50K. Now, your PI may not spend all of that all at once. They may not spend any of it. They may get 50, 50, 50, and then spend 200 all at once. Whatever it is, this cash is at hand, and what you're spending is based off of the cash. Now, there typically needs to be a way to distinguish this money in your financial systems. They'll always have their own account numbers and are typically extremely low risk because you have the cash in hand. You're going to spend against the cash. The compliance risks are different. And the real issue with these gifts is that there is really one, that you have to make sure that gifts and grants are being allocated appropriately, and that is a completely different video and a completely different set of compliance issues and not related to this one, and we'll come to that in another video. However, the issue with these gifts related to this particular conversation is that they are all different. So when you find out you have an account like that, what I recommend is always go looking for the letter. So if you have an account and it's a discretionary account and it's called Dr. So-and-so's discretionary, find the letter, find the email, find something that tells you what it is. If it doesn't exist, figure out what it is by asking questions, and then make sure you put that in the notes in the folder or your reconciliation thing. But what you're looking for is something that says from the person or the organization saying they're going to give money. Okay. If it's a one-time payment of $50,000, it should be noted. If we're expecting more, make notes on when the other payments are expected and put those on your reconciliation sheets so that you know when you want to check up on them. Also, so that you know if, for example, an account's going into deficit, but you know another $50,000 is going to be here in like 2 days, it's not as much of a big deal as if an account is in deficit and there's no money coming in. So typically what I do is I'll put these in my reconciliation sheets, and when I do my monthly reconciliations, I will follow up on or around those dates about when we're expecting the funding. Now, if I'm not able to easily determine, looking at this, when our last disbursement was received when I take over a portfolio, I will typically reach out to the development department or whatever it's called in your organization who handles gifts to find out when was the last time that we got a payment and what the schedule of payments is. Keep in mind that larger organizations will typically have an entire department whose sole job it is to solicit funds from donors, and they are on top of it. And it's great to develop a good relationship with that department and have a free flow of information to ensure that you always know when new cash accounts are opening up, when new payments come in, and you're kept in the loop. But typically, it is really important and useful to get whatever information you can so that if there is more money expected to come in, you can notate it on your spreadsheet so that when you have your meetings with your PI on a monthly basis, you can update them on status of payments, or at least make notes in your reconciliations like that every 6 months you need to check on something, or every year you need to check on something. These kinds of notes are also really, really helpful when it comes to transitioning portfolios to new RAs or to whoever it is that takes over after you if you're transitioning somewhere else, because then they know what to expect and they know what they should be doing, and they can just pick up where you left off. Next up is clinical trials. Now, I used to be terrified of clinical trials, but now they're really, really one of my favorites. And they are extremely complicated sometimes, and other times they're extremely simple. Now, I'm calling them clinical trials. We're talking about sort of, these are more like milestone payments or patient enrollment payments or so on, but it's a different type of mechanism by which we receive the money. Okay. So these types of projects can be incredibly complicated sometimes. Like, oh my God, it's so complicated, you need like 40 spreadsheets. And other times they're very, very simple to manage. It really depends on the nature of the science, who the sponsor is, what your PI does, and so on. Okay. However, in terms of how you get the money for clinical trials, this is typically going to be milestone-based or patient-based. Now, you may get startup payments of a certain amount. In some cases, they'll be really large, and then other times it's a small token amount. But once you have that startup fee, which is typically given like sort of on the signing of the contract, other payments are not made until the PI does something, or tells the sponsor how much they enroll, delivers some sort of product, or reaches some sort of a goal. There is a deliverable associated with the payment itself. This is all really, really clearly outlined in the contract. It's signed, there will be a schedule of payments that, for example, may say that you'll be paid $100 per patient you enroll, and you'll bill us in 3-month increments. And so the PI and their staff will submit a milestone chart saying, I enrolled 100 patients. That would typically mean that the funding organization is now going to pay us $10,000. Typically, those $10,000 are total costs, in which case it will, once we receive it, it gets distributed between direct and indirect costs. So the PI may not necessarily see the full $10,000. They may get a varying distribution depending on the IDC rates for clinical trials at your organization. Now, we as RAs, or at least in terms of the experience that I have had, are not typically involved in invoicing or keeping track of milestones. This is done at the PI level, and then typically there's a clinical or clinical research or some sort of office that does the invoicing. However, on the RA level, I always keep up with the milestones. I check in with the PI so I know where we're at, so I can gauge where we are, how much we're spending, and when we're going to get the money. Because I've had projects where I'll meet with the PI and they'll tell me we're spending, but I'm not going to be ready to invoice them for another year because we're waiting on the publication. So at that point, well, you're going to be waiting for a while and they're still spending. And so then the question becomes, how are we going to cover this if we don't get paid? Is there any risk here? Depending on the experience of your investigator, they may be able to have these kinds of conversations with you and really have a strong understanding of what their relationship with the sponsor is, and they'll be like, yeah, no, this is not at risk at all. It's totally fine. This is great. And then they're also able to say, I'm concerned about this. We probably need to talk about how we're going to deal with this. But you'll also have investigators that are not fully aware of how these things can go. Like maybe they don't have a lot of experience in clinical trials or so on. And so it behooves us to sort of stay on top of the deficits in these accounts, what we're invoicing for, and understand the context of the conversations we have with the PIs. Like, okay, is this really at risk? Is it not at risk? What do I need to do to make sure that I'm not going to have a conversation with the chief in like 10 months saying we need to pay off this person's deficit because they have no discretionary money or so on, right? Nobody wants to be in that position. Now, sometimes it doesn't matter, right? PI, it's fine, but it's important to have this information so that we can stay on top and understand what the research business enterprise is looking like our research business enterprise. Now, I've also had other PIs who have really high patient enrollment or who are hit the milestones are working with the clinical trials groups or whoever does the invoicing to invoice really regularly. You'll want to check in with your manager or whoever hired you into this position to find out what is your role if you have any clinical trials or any accounts like this. What is your role? Who are the people that you need to know? There is probably an office in your organization that liaises with the PI for clinical trials to get invoices out and so on. They typically will manage like that part of it. And once the funds come in and hit the account, that's when we get more deeply involved. So there's a team relationship sort of thing going on here, and we work together in order to make the clinical trials happen. But ultimately, the thing to remember in the context of, again, how do we get the money, is that these are funds where you do the work in advance and then you get paid afterwards, okay? And the problem with that is it is very, very, very high risk, because if the PI doesn't meet their milestone, or let's say the patient, the PI has trouble enrolling people into the study, there's still effort being expended to do this work, and it's costing somebody something, right? And so the key element here is to look through the contract for every clinical trial so that you understand what the payment schedule is, and when you meet with your investigator, asking if you've met this and we're ready to invoice. So, for example, when I meet with a PI, and I know for this account, Rainbow Bright Industries, we get paid $10,000 when you hit the first milestone. How close are you to hitting that first milestone? And the investigator will tell me, oh, we're not at risk, we're not close at all, we're having trouble. They sort of talk through it, and we have a conversation about it. And it helps me to understand the context in which the clinical trial or this particular study is occurring, what expectations there are, and sort of like where we're at. What can I expect? Because I need to know if the money is at risk and if the funds are at risk. And sometimes they are and sometimes they're not, but your investigator will let you know. Then you have other types of industry contracts that are not clinical trial related. And these are very similar in that they are milestone based. So typically the amount of money you get is different and the schedule that you get is a little different. But they have different milestones unrelated to patients, right? They may be written more like, we're going to give you $25,000 upon signing the contract, $25,000 upon reaching this goal, $25,000 upon doing this goal, and then $100,000 at the very end when you publish or whatever. And those are fairly straightforward because those are a steady schedule, and they'll sort of say, well, we expect this to be the date of the first payment, which is like on signing. Usually they'll give you that first payment, and then the second payment and the third payment. Now, if there is no date there, then you just keep up with the investigator to find out, hey, when are you planning on submitting this? I've had studies that happen really quickly, like where it's 1 year beginning to end, in and out. Some of them maybe even shorter. Like I had one that was 10 months. It was really, and then others, they go on for years and years, incurring expenses and running in arrears and then getting a giant payment somewhere in the middle or the end. So these are not unusual, but the key thing to make sure is that you're having these conversations with your investigator, because these are also funds that are at risk. Something to consider about this is because some of these payments come in like big chunks where it's like, okay, I'm going to give you a big, $50,000 or $30,000 payment. You may have an account that runs in arrears for a little while, and then you get this giant payment that then wipes out the deficit, puts you in a surplus, and lets you spend for the next 3 to 6 months without issue. So these kinds of accounts can be very up and down and so on. One of the most difficult things that I've had to deal with, and this is really important related to these types of accounts, is with newer investigators who don't understand how these milestone works, and that they don't actually have cash in hand simply because they're doing the work if they don't actually deliver the thing that they need. They do not realize sometimes that the payment is dependent upon meeting these goals, even though it would seem like, okay, it's in the contract, it's there. if you do not have someone who has done this before, they may not be aware of administratively how these things happen, or that they need to take a specific action to be able to get those funds. So like maybe they hit the milestone, but they don't put it in the exact reporting system they need to because they didn't read the contract or somebody didn't tell them. So then we don't get paid. So it's important to make sure that when you meet with an investigator that you sort of gauge, like, generally speaking, these are the things that you're going to need to do so that we can get the payments. I've actually taken over portfolios in my life where there just weren't any funds left because to be spent because they met the milestones, or they did not let anyone know. They thought the money had just come in, and then by the time they got around to doing it, it was past time where we could actually get the money. And so now they don't have the money, they have a deficit, and we run ourselves into that same situation. So these are why these accounts can sometimes be fairly risky. Next up, we're going to talk about cost reimbursables for subawards agreements or amendments. Now, these sorts of agreements are often subcontracts, which typically involve incurring expenses over the course of a month, and then invoicing the prime, the pass-through entity, for those expenses. Okay? So typically when setting up a subcontract, we send out an agreement that must be fully executed by both parties before any invoicing can begin. Now, even though it's crucial to execute these agreements as quickly as possible, many central offices are very behind in processing their agreements and amendments just because the amount of work that exists in our industry is enormous. A lot of paperwork. There's just so much to do that there's just a long lag. This amount of overwork impacts us all. That makes these types of projects a little risky short term, though, because they're often issued as pass-throughs for larger NOAAs, the risk is mitigated a little bit. But let's talk about how this might play out in real life. So a PI gets a notification from the prime saying, hey, we were funded, here's the NOAA, look, yay. And so we say, okay, we're, in this case, the PI is the subsite, and they begin work immediately. So we set up an advance account of some kind, but we don't have the fully executed agreement until October 1st. Okay, so the work starts on May 1st. We don't get the agreement until October 1st, like fully executed. Okay, but that means we can't invoice, okay? Because you can't invoice without having a fully signed contract. But the PI is still working and is still charging expenses to an advance account, and we're racking up expenses with no one paying the other end of it. That's 6 months of salary, 6 months of supplies, 6 months of work. And we're talking just regular research here. Just normal day-to-day research, whatever type of research it is, it's all happening, and things are being charged, and the organization that the PI belongs to and the subsite is floating that expense, okay? Now, just as an aside, an advance account is an account that is set up to be used before an agreement is officially signed so that an investigator can appropriately allocate expenses to the project even if funds hadn't come in. Not all organizations utilize advance accounts, but some organizations do. So it's definitely a question you want to ask your manager. So let's say, for example, in this story, the project started May 1st and you don't have an advance account. Okay, let's pretend there is no advance account, okay? And the PI is working on this project. Where are these salaries charging? They're charging then to accounts that they don't belong on. There are expenses posting on accounts that they don't belong on, which means that when the contract is finally executed, it will result in an enormous amount of labor to move all of these expenses from whatever accounts they were on to the correct one. Not to mention, the opportunity for risk is incredibly high in terms of compliance because some of these expenses, like, you're talking about the transfer in November and they were made in May 1st, May 6th, May 7th. How do you know exactly what goes where? This creates a lot of issues, and not to mention the fact that not having distinct accounts creates a real lack of transparency and ability to adequately assess allocability, allowability, reasonableness, consistency, the whole nine. It's a compliance nightmare, and so the advance account is how many organizations will mitigate that issue. Now, while we are incurring these expenses on this advance account, everything is running in deficit on this account. Once the agreements or amendments are fully executed and signed by both sides, we can issue invoices for all accrued expenses. So now literally an invoice for the last 6 months goes out. Okay, so it's a giant invoice, right? That invoicing, once it is received by the prime, it triggers the payment process at the prime institution, which in and of itself can be lengthy. Okay. After the prime institution processes the payment and the expenses are recorded on their side, when they do their monthly drawdown, so now they've paid our PO, now they're floating that expense on their end, and then when they do their drawdown, they will draw down from the payment management system. They will invoice the foundation or whatever it is so that they get reimbursed for our expenses after they pay us, okay? This complexity increases insanely if you have a sub of a sub. Okay. I have only had a few of those in my career. They are very high risk. As an RA, you may not be involved in the back-end intricacies of payments and drawdowns, but you may be involved peripherally in other aspects of the payment cycle. So what I would recommend is ask your manager what your role is in this space and who your contacts are to liaise with within your organization for clinical trials, for technical ventures, for development, for research finance. What are they called in your department? The parts that you are not responsible for will be aspects of the project that they deal with. And between you, the PI and their staff, and this additional group of people, you have a full team managing any individual project. And it's helpful to know who each of your resources are so that as you're working on your reconciliations, your closeouts, or getting ready for a meeting with your PI, you can act as the research enterprise business manager, tying all of these things in together. Thank you so much for watching. Let me know what you thought in the comments, and please feel free to share your thoughts, experiences, agreements, or disagreements. And do not forget to like and subscribe so you get notified every time I upload a video with more research administration stuff.